Remember when $100 could fill your grocery cart? Or when $1,000 felt like a substantial emergency fund? Inflation has changed all that, and it's happening much faster than most women realize. What you could buy for $10 in 2000 now costs over $16, effectively cutting your savings by more than a third. I've spent years helping women protect their wealth from this invisible thief, and today I'm sharing my exact 3-step system. You'll learn the specific investment allocation percentages that work during high inflation, including why keeping more than 20% of your savings in cash might be the biggest financial mistake you're making right now. The silent wealth thief revealed. What if I told you someone's been stealing from your bank account every single day, and you've been letting them? This isn't some elaborate scam or a shady hacker. It's something much more insidious, happening right under your nose, affecting every dollar you've worked so hard to save. I'm talking about inflation, the silent wealth thief that's constantly eroding your money's purchasing power. While you're carefully budgeting and making smart choices about your spending, inflation is quietly making your dollars worth less and less with each passing month. Let's break this down with a simple example we can all relate to. Remember your grocery trips from 5 years ago? That carton of eggs that cost you $2.19 now rings up at $4.21. The loaf of bread that was $2.50 is now $3.89. Your favorite coffee that was $12.99 a bag has jumped to $18.50. These aren't random price increases. They're the very real, very visible signs of inflation eating away at what your money can buy. The statistics paint an even clearer picture. Over the past decade, the US dollar has lost nearly 30% of its purchasing power. Think about that. $1 today buys you what 70 cents could buy just 10 years ago. And in the last year alone, inflation has hovered around 4 to 9%, depending on what you're buying. That's not just a number on a news ticker. It's a direct hit to your wallet. This impact becomes dramatic when we look at your savings. Let's say you've done everything right and built up a $10,000 emergency fund. First of all, congratulations. That's a huge achievement. But here's the harsh truth. If that money has been sitting in a typical savings account for the past 5 years, it's lost over $1,700 in purchasing power. That's money that simply vanished without you ever spending it. To make this even more tangible, let's compare what $100 could buy you in 2018 versus today. 5 years ago, $100 would cover a nice dinner for 2 at a mid-range restaurant with drinks, appetizers, and dessert. Today, that same experience would cost you closer to $140. 5 years ago, $100 could fill your gas tank about twice in most cars. Today, you might get 1 full tank and a quarter of the second. What's particularly concerning is that for young women, this impact can be even more severe. Studies show that the specific goods and services that women tend to purchase more frequently, like personal care products, healthcare services, and education, have experienced even higher inflation rates than the general average. This creates what economists call a pink tax premium on inflation, making the burden even heavier. And this isn't a temporary problem that's going away soon. Inflation has become a persistent feature of our economy, with the Federal Reserve even changing their long-term approach to managing it. The days of 2% predictable inflation may be behind us. So what happens if you keep ignoring this silent wealth thief? Let's say you have $35,000 in savings, a fantastic achievement. With inflation at 6%, you're losing $2,100 in purchasing power every single year. That's $175 every month just disappearing from what your money can buy. It's like having a subscription service you forgot to cancel, except instead of charging your credit card, it's stealing your future financial security. The most frustrating part? Traditional advice like just save more doesn't solve this problem. In fact, simply saving without a strategy makes you more vulnerable to inflation's effects. I know this sounds alarming, and it should be. But here's the good news. You don't have to sit back and watch your hard-earned money lose value. There's a 3-step approach that can not only protect your wealth from inflation, but potentially help it grow even during these challenging economic times. And the best part, you don't need to be a financial expert or have tons of extra cash to implement it. Your monthly wealth leak, calculating your personal inflation rate. Let's see exactly how much of your hard-earned money is actually disappearing each month. The three-step approach I mentioned starts with something most financial advisors never discuss with you: your personal inflation rate. This number is critical because the inflation you're personally experiencing might be drastically different from what you hear on the news. Think about it. The Consumer Price Index, CPI, that gets reported is just an average across the entire country and all demographics. But your life isn't average, is it? Your spending patterns are unique to you, which means inflation affects you differently than it affects everyone else. Here's the truth. For many young women, the official inflation numbers are painting a much prettier picture than reality. The categories where you might spend more of your income, like healthcare, education, and housing, have seen price increases that make the general inflation rate look tiny by comparison. So how do you figure out your personal inflation rate? It's actually pretty straightforward. Take a look at your bank statements from this year and compare them to last year's spending in the same categories. For each category, calculate the percentage increase. For example, if you spent $800 on groceries monthly last year, but now you're spending $880, that's a 10% increase just for food. Do this calculation for all your major spending categories. The differences can be eye-opening. Maybe your rent increased by 12% while your healthcare costs jumped 15%. Meanwhile, your entertainment costs might have only gone up by 3%. When you calculate the weighted average based on how much of your budget goes to each category, you'll have your personal inflation rate. Let me walk you through a quick example. Let's say you spend your monthly budget roughly like this: 40% on housing, 15% on food, 10% on transportation, 15% on healthcare, 20% on everything else. If housing costs rose 7%, food increased 10%, transportation jumped 6%, healthcare spiked 15%, and everything else went up 5%, your personal inflation rate would be about 8.3%, potentially much higher than the official number. This matters because if your personal inflation rate is 8.3% and your savings account is paying 0.5% interest, you're effectively losing 7.8% of your money's value every year. On a $10,000 savings account, that's $780 vanishing annually, or about $65 every month. For young women specifically, certain categories tend to hit harder. Take education, for instance. Tuition costs have consistently increased at rates that outpace general inflation, which disproportionately affects young women pursuing higher education or paying off student loans. Healthcare is another area where women often face higher costs. Medical expenses have been rising faster than the CPI for years. If you're managing healthcare expenses, whether it's regular checkups, prescriptions, or specialized care, your personal inflation rate is likely feeling the impact. The compounding effect of this monthly wealth leak is what makes it so dangerous. If you're losing 2% of your purchasing power each month, it might not seem like much in January. But by December, that compounding loss has created a significant hole in your financial bucket. What's particularly concerning is when this hidden leak continues year after year. 5 years of an 8% personal inflation rate doesn't just mean you've lost 40% of your money's value. It's actually worse because of compounding. Your money isn't just leaking, it's flooding out. This is why understanding your personal rate is so critical. When you know exactly how much your money is depreciating each month, you can make informed decisions about protecting it. The national averages don't tell your story. They tell everyone's story averaged together, which means they're probably not accurate for you. Take some time this week to sit down with your statements and calculate your personal inflation rate. You might discover that inflation is stealing twice as much from you as you thought. And that knowledge, it's the first step in fighting back. The savings account trap, when safety becomes dangerous. Now that you've figured out your personal inflation rate, let's talk about where that money is actually disappearing to. Your grandmother probably told you that saving money was the responsible thing to do. And for her generation, that advice made perfect sense. Back in the 1980s, a regular savings account could earn you interest rates of 8% or higher. Imagine that, putting your money somewhere safe and watching it grow faster than inflation. Those accounts weren't just storing money. They were genuinely building wealth for everyday people. Your grandparents could literally watch their savings multiply while they slept. But here's the reality check. That world doesn't exist anymore. Today, if you check your savings account interest rate, you'll likely find something shocking. Major banks are offering a measly 0.05% to 0.10% interest. Meanwhile, inflation has been running at around 8% in recent years. See the problem? The very place you're keeping your money safe is actually where it's losing value the fastest. Let me show you exactly what this means with some real numbers. Say you have $10,000 in a typical savings account earning 0.05% interest. Over a year, you'll earn a grand total of $5. Yes, $5. That wouldn't even buy you lunch at most places these days. But here's where it gets painful. With inflation at 8%, the purchasing power of your $10,000 is actually decreasing by $800 over that same year. When you do the math, that's a net loss of $795 in real terms. Your safe money is silently shrinking right before your eyes. Think about that. You're essentially paying the bank $795 a year to hold your $10,000. Does that sound like a good deal to you? But wait, you might be wondering, if the bank is paying me next to nothing, what are they doing with my money? That's the interesting part. Banks take your deposits and lend that money out or invest it at much higher returns than what they're paying you. While you're getting that 0.05%, they might be earning 4%, 5%, or more on your money. In today's low-interest environment, banks are having a field day. They attract your deposits with promises of safety and convenience while offering minimal returns. Then they turn around and use those deposits for lending and investments that generate substantial profits. The gap between what they pay you and what they earn is essentially their profit margin, at your expense. So how can you tell if your savings account is actually making you poorer? There's a simple formula you can use. Real return equals interest rate, inflation rate. If the result is negative, your money is losing purchasing power. Let's put this formula to work with current numbers. If your savings account offers 0.05% interest and inflation is at 8%, your real return is 0.05% to 8% equals minus 7.95%. That negative number represents your annual loss in purchasing power. I've talked with so many young women who had this eye-opening realization. One told me how she had diligently saved $30,000 over 5 years, only to discover that her money could buy significantly less than when she started saving. She was doing everything right according to conventional wisdom, avoiding debt, building an emergency fund, saving regularly, yet her financial position was actually deteriorating. I was so proud of my savings discipline, she shared. But then I realized I could barely afford the same groceries and rent that I could when I started saving. It felt like running on a treadmill that was secretly moving backward. This isn't an isolated story. Countless women are realizing that the traditional savings approach that worked for previous generations is actually harmful in today's economy. The financial rules have changed, but much of the advice hasn't caught up. So what's the alternative? Is there a way to actually protect your money from inflation rather than watching it slowly disappear? Your financial defense plan, the 3-step framework overview. When your money loses 8% of its value while earning just 0.05% interest, you're not really saving. You're slowly giving away your financial future. What most financial advisors won't tell you is that this gap between inflation and returns isn't something you have to accept. It's actually an opportunity that smart investors have been quietly capitalizing on for decades. The traditional financial advice most of us received growing up just doesn't work anymore. Remember when our mothers and grandmothers could put money in a savings account and actually watch it grow? That world is gone. Today's financial landscape requires completely different strategies, especially for young women who face unique challenges like longer life expectancies and potentially lower lifetime earnings. Here's the thing about most mainstream financial advice. It was designed for a world with 2% inflation and 5% savings rates, not our current reality. The classic 60-40 stock and bond portfolio that advisors have recommended for generations simply falls flat in today's environment. This outdated approach is particularly problematic for young women who need their money to work harder to overcome gender pay gaps and longer retirement periods. But what if I told you there's a 3-step framework that doesn't just protect your money from inflation, but actually transforms inflation into a wealth-building opportunity? This isn't some get-rich-quick scheme. It's a practical approach based on economic principles that Warren Buffett himself uses. Let me break down this 3-step framework for fighting inflation. First, strategic stock investments in companies with what Warren Buffett calls pricing power. These are businesses that can easily pass increased costs to consumers without losing customers. As Buffett explains, the ideal companies can accommodate large dollar volume increases with minimal additional capital investment. Think about it. When a company can raise prices during inflation without losing customers, their profits can actually grow while other businesses struggle. Second, avoid long-term bonds, which are particularly vulnerable during inflationary periods. This part of the strategy might sound counterintuitive if you've always heard bonds are safe, but the math simply doesn't work in your favor when inflation rises. We'll explore exactly why in the next section, but for now, understand that what's traditionally considered safe might be quietly eroding your wealth. Third, allocate a portion of your portfolio to inflation hedges, assets specifically designed to maintain or increase in value during inflationary periods. These might include precious metals, certain commodities, or other alternatives that we'll explore in detail later. What makes this framework so effective is how these three components work together. It's not just about picking one approach. It's about creating a comprehensive shield that protects your money from multiple angles. When one element might be underperforming, another can pick up the slack. Let me share a quick case study. One of my viewers, Jessica, implemented this framework last year when inflation started climbing. She adjusted her investment portfolio following these three steps. She moved money from her savings account into quality stocks with pricing power, avoided adding to her bond positions, and allocated about 15% of her portfolio to inflation hedges. While her friends complained about losing purchasing power, Jessica's portfolio actually gained value in real terms, even after accounting for inflation. The key insight from Jessica's experience wasn't just that she made money. It's that she took action when everyone else was waiting to see what would happen. This highlights something crucial. Waiting for inflation to go back to normal before adjusting your strategy could cost you thousands in lost purchasing power. Every month you delay is another month your money silently shrinks. In the coming sections, we'll dive deeper into each part of this framework, including exactly what percentage of your portfolio should go where based on your age and goals. I'll show you specific examples of companies with strong pricing power, explain which types of bonds to avoid completely, and reveal which inflation hedges have historically performed best during periods like the one we're in now. Step 1. Strategic stock investments with pricing power. When inflation strikes, there's a hidden sorting mechanism in the market that separates companies into winners and losers. The average investor focuses on the wrong metrics, but Warren Buffett specifically looks for one quality that turns inflation from a threat into an opportunity. This single characteristic has helped him outperform the market during every major inflation spike since the 1970s. That quality is pricing power, a company's ability to raise prices without losing customers. Think of it as a business superpower during inflationary times. When costs rise, most companies face a painful choice: absorb those costs and watch profits shrink, or raise prices and risk losing customers. But companies with genuine pricing power can increase their prices right alongside inflation, or even beyond it, while customers keep coming back. Let's look at what happens to companies without this advantage. Imagine a grocery store chain with razor-thin profit margins competing against several similar stores in the same area. When their supplier costs rise due to inflation, they're stuck. If they raise prices too much, customers simply shop elsewhere. If they don't raise prices enough, their profits disappear. Either way, they're in trouble. Now contrast that with Apple, a company with extraordinary pricing power. When production costs increase, Apple can simply adjust the prices of iPhones and MacBooks without seeing a significant drop in sales. Their loyal customers remain willing to pay premium prices because of the perceived value, ecosystem benefits, and strong brand identity. That's why Apple has consistently raised prices for its products over the years while maintaining healthy profit margins. Similarly, Facebook, Meta, demonstrates impressive pricing power in the digital advertising space. When economic pressures mount, they can adjust advertising rates based on demand without losing their advertiser base, as businesses rely heavily on their platform to reach consumers. Both Apple and Facebook have shown remarkable resilience during inflationary periods because of this ability to pass increased costs directly to consumers. Historically, certain sectors have demonstrated superior performance during high inflation. Consumer staples companies, Think household necessities that people buy regardless of economic conditions. Often maintain steady sales despite rising prices. Healthcare businesses typically possess strong pricing power because their services are essential and often covered by insurance, creating a buffer against price sensitivity. Technology companies, particularly those with strong intellectual property or network effects, can also thrive by continuously improving their offerings while adjusting prices upward. Buffett's approach to identifying these inflation-resistant companies is surprisingly straightforward. He looks for businesses with what he calls an economic moat, a sustainable competitive advantage that protects their market position and allows them to maintain pricing power even when costs rise. This could be a strong brand, like Coca-Cola, a near-monopoly position, like Visa or MasterCard in payment processing, or a cost advantage that competitors can't easily replicate. You don't need Warren Buffett's decades of experience to identify companies with pricing power. Look for these key characteristics. First, strong branding that creates emotional connections with customers who will pay more to stay with the brand they trust. Second, a loyal customer base that demonstrates low price sensitivity and high repeat business. Third, continuous innovation that keeps the company's products or services competitive and desirable despite price increases. Companies operating in markets with limited competition or offering unique products that can't be easily substituted also tend to maintain stronger pricing power. When customers have few alternatives, they're more likely to accept price increases rather than go without the product or service altogether. When building an inflation-resistant portfolio, quality stocks with pricing power should form your foundation. Based on historical performance during inflationary periods, allocating 80 to 90% of your investable assets to these types of stocks provides the best chance of outpacing inflation over time. This percentage might seem high compared to traditional advice, but remember, the traditional 60-40th stock/bond split was designed for a low inflation environment that simply doesn't exist right now. Within that stock allocation, prioritize companies demonstrating the pricing power characteristics we've discussed. Look beyond flashy growth numbers to examine profit margins over time. Companies that maintain or expand the perfect portfolio, exact allocation percentages for inflation protection. Finding companies with pricing power is just the first step in building your inflation-resistant portfolio. The real magic happens in how you distribute your money across different investments. Did you know that during the 1970s inflation crisis, certain portfolio structures lost over 50% of their purchasing power, while others actually gained wealth? The difference often came down to just a 10 to 15% shift in allocation strategy. That traditional 60-40 portfolio split, the one where you put 60% in stocks and 40% in bonds, completely collapsed during the last major inflation crisis. It left millions of Americans watching their retirement funds evaporate in real terms. This classic allocation was designed for a world with modest inflation and higher interest rates, not the economic environment we face today. Let's look at what happened in the 1970s when inflation really took off. Long-term bonds, which were supposed to be the safe part of people's portfolios, experienced devastating losses. Treasury bond prices dropped by 30% to 50% or more. While stocks struggled too, they eventually recovered and adapted to the new economic reality. Bonds, on the other hand, remained underwater for years. So what should your portfolio look like today? The answer depends largely on your age. If you're under 40, the research suggests allocating 80 to 90% of your investable assets to stocks. This might sound aggressive if you've been following conventional wisdom, but stocks generally outperform other asset classes during inflationary periods, especially over longer time horizons. For those of you between 40 and 60, a more balanced approach makes sense, about 70% stocks and 30% inflation hedges. The closer you get to retirement, the more you need to protect what you've built. If you're over 60, consider scaling back to 60% stocks and 40% inflation hedges to provide more stability while still fighting inflation. But wait, you might be thinking, what exactly are inflation hedges? These are investments specifically designed to maintain their value when inflation rises. Think precious metals, commodities, or energy stocks. The research suggests including about 5 to 10% of your portfolio in these hedges, regardless of your age group. They act as insurance against extreme inflation scenarios that could otherwise devastate your wealth. What makes these allocation recommendations so powerful is the historical data behind them. Looking at past inflationary periods, stocks purchased at reasonable valuations have consistently outperformed bonds over time. The key is understanding that inflation doesn't affect all investments equally, and small adjustments to your allocation can make a huge difference. Let me show you how to rebalance your existing portfolio to match these recommendations. First, take a quarterly approach. Set calendar reminders in January, April, July, and October to review your portfolio. Second, compare your current allocations to the target percentages for your age group. Are you overweight in bonds? Underweight in stocks with pricing power? Then make the necessary adjustments to get back on track. Something that surprises many people is how much impact even small changes can have. Increasing your stock allocation by just 5% can significantly enhance your potential returns during inflationary times. That might not sound like much, but over a decade, that small shift could mean the difference between losing purchasing power and growing your wealth. I know what some of you are thinking. Isn't this too risky? What if the stock market crashes? It's a valid concern. But consider this. The biggest risk during inflation isn't a temporary market dip. It's the permanent erosion of your purchasing power. While stocks may fluctuate in the short term, quality companies with pricing power have historically adapted to inflation over time. Another common objection I hear is, I don't want to be checking my investments constantly. Good news, you don't have to. This strategy requires quarterly check-ins at most, and many brokerages offer automatic rebalancing tools that can handle the adjustments for you. So what's the bottom line for your index funds versus I-bonds allocation? If you're under 40, consider putting 85 to 90% in quality stock index funds that contain companies with pricing power, 5 to 10% in inflation hedges, and minimal amounts in I-bonds or similar fixed income investments. If you're over 60, that mix might shift to 60% stocks, 25 to 30% I-bonds or similar short-duration fixed income, and 10 to 15% in inflation hedges. Step 2. The bond danger zone. What to avoid and why. Now, those allocation guidelines we just discussed are a great start. But I need to warn you about something that might be lurking in your portfolio right now. That safe investment you've been holding on to could actually be draining your wealth at an alarming rate. During the 1970s, inflation crisis, some bond investors lost over half their purchasing power while thinking they were playing it safe. That's right, bonds can be more dangerous than stocks during inflation. But wait, isn't that the opposite of what we've always been told? For decades, financial advisors have recommended bonds as the stabilizing force in a portfolio. The conventional wisdom goes something like this. Stocks are for growth and bonds are for safety. As you get older, you're supposed to increase your bond allocation to reduce risk. This advice made perfect sense in a low inflation environment. Bonds typically offer steady, predictable income through regular interest payments. They're less volatile than stocks on a day-to-day basis. And historically, when stock markets crashed, high-quality bonds often held their value or even increased as investors fled to safety. But here's what your financial advisor probably hasn't explained. Bonds have a major weakness, and that weakness is inflation. The problem lies in the fundamental nature of bonds. When you buy a bond, you're essentially lending money at a fixed interest rate. Let's say you purchase a 10-year treasury bond paying 3% annually. That sounds fine when inflation is at 2%. You're earning a real return of 1% after inflation. But what happens when inflation jumps to 7% or 8%? Suddenly, your safe 3% bond is losing 4 to 5% of its purchasing power every year. And it gets worse. When inflation rises, central banks typically respond by raising interest rates to cool down the economy. This creates a mathematical nightmare for existing bondholders. As new bonds come to market with higher interest rates, your old 3% bond becomes less attractive. Who wants your 3% bond when new ones are paying 6% or 7%? The market value of your bond drops dramatically. This is the inverse relationship between interest rates and bond prices that many investors don't fully understand until it's too late. And the longer the term of your bond, the more severe the price drop. This isn't just theoretical. During the 1970s, as inflation surged, long-term bond investors watched in horror as their supposedly safe investments plummeted in value. Depending on the bond's maturity, losses ranged from 30% to over 50%. These weren't just paper losses. Investors who needed to sell their bonds before maturity locked in these devastating declines. Think about that. Someone who invested in safe long-term government bonds could have lost half their money, while simultaneously watching inflation erode the purchasing power of whatever was left. Not all bonds carry the same level of inflation risk, though. Short-term bonds, those maturing in 1 to 3 years, are much less vulnerable to interest rate changes than long-term bonds, 10 to 30 years. Treasury inflation-protected securities, TIPS, have built-in inflation adjustments, though they typically offer lower starting yields. I-bonds, which we discussed earlier, have direct inflation protection built in. Corporate bonds generally offer higher yields than government bonds, but come with additional risk. If inflation drives up a company's costs significantly, there's a higher chance they might struggle to meet their bond payment obligations. So what should you do instead? Remember those companies with pricing power we talked about? Their stocks provide a much better inflation hedge than traditional bonds. Real assets like real estate investment trusts, REITs, can also help, as property values and rents tend to rise with inflation. Commodities, precious metals, and other inflation hedges we'll discuss in the next section can fill the role that bonds traditionally played in portfolios. This is particularly important for women investors. Traditional financial advice often steers women towards safer investments like bonds and savings accounts, claiming they're more risk-averse. But this outdated guidance fails to account for inflation risk, which can be especially damaging to women's long-term financial health. With longer life expectancies and potentially lower lifetime earnings due to wage gaps and career breaks, women simply can't afford to have their purchasing power steadily eroded by well-meaning but flawed safe investment strategies. Step 3. Adding inflation hedges to your portfolio. Let's talk about the third critical piece of our inflation protection strategy. While stocks with pricing power can help grow your wealth, and avoiding bonds can prevent unnecessary losses, there's a special category of investments that can serve as your financial umbrella when inflation storms hit hardest. These investments are called inflation hedges, assets specifically designed to maintain or increase their value during periods of rising prices. Think of them as your portfolio's specialized defense system that activates precisely when inflation threatens your purchasing power. The truth is, most young women have zero inflation hedges in their investment mix. This isn't surprising when you consider how traditional financial education rarely emphasizes these protective assets. Many financial advisors skip over them entirely, particularly when counseling women investors, assuming they're too complex or risky. But in today's economic environment, not having these protective elements in your portfolio is the bigger risk. Let's break down the main types of inflation hedges you should consider. First up are precious metals like gold and silver. These have served as stores of value for thousands of years. During Germany's devastating post-World War I hyperinflation, gold owners preserved their wealth while paper money became worthless. The advantage of precious metals is their historical stability during inflationary periods. They tend to maintain purchasing power when currencies falter. The downside: they can be price volatile in the short term and don't generate income while you hold them. Next are commodities and energy stocks. These tend to perform exceptionally well during inflation because their prices typically rise alongside or even ahead of general inflation. Remember that energy was the best performing sector in the S&P 500 during the first 7 months of 2021 as inflation began heating up. The major advantage here is their potential for strong returns during inflationary periods. However, they do carry risks related to market fluctuations and can be impacted by geopolitical events. Real estate investment trusts, REITs, offer another powerful inflation hedge. These investment vehicles own and operate income-producing real estate, and they provide a natural hedge because rental income typically increases with inflation. This helps preserve your purchasing power while potentially generating growth. The catch: REITs can be sensitive to interest rate changes, which might affect their performance in certain inflationary environments. Finally, there are Treasury inflation-protected securities, TIPS. These are government bonds specifically designed with inflation protection. Their principal value increases with the consumer price index. They're considered safer than other inflation hedges, but come with their own limitations. Their effectiveness depends on whether you trust the government's CPI reporting to accurately reflect true inflation, and they may yield lower returns than traditional bonds if inflation turns out lower than expected. So how much of these inflation hedges should you actually hold in your portfolio? Research suggests allocating between 5% to 10% of your portfolio to inflation hedges for a balanced approach. If you're particularly concerned about extreme inflation scenarios, you might consider bumping that up to 10% to 15%. Your specific allocation should reflect your risk tolerance and time horizon. Younger investors might lean toward the higher end of that range. Let's be clear about something. You don't need specialized accounts to purchase these inflation hedges. You can buy most of them through your regular brokerage account. For precious metals, you can invest in ETFs that track gold or silver prices rather than buying physical metals. For commodities, commodity-focused ETFs provide simple exposure without dealing with futures contracts. REITs trade just like stocks on major exchanges, and tips can be purchased directly from the Treasury or through ETFs. What's particularly interesting is how these hedges have performed during previous periods of economic uncertainty. While stocks and bonds faltered during the inflation of the 1970s, commodities and gold delivered strong returns. REITs have historically provided both income through dividends and appreciation potential that can outpace inflation over time. The key is understanding that these assets behave differently than your core stock investments. They're not meant to replace your primary portfolio. They complement it by activating their protective properties precisely when traditional assets struggle. Real-life application. Sarah's Inflation Shield success story. When theory meets reality, that's where the real financial magic happens. Let me introduce you to Sarah, a 27-year-old marketing manager whose story perfectly demonstrates how these inflation-fighting techniques work in the real world. Not just on paper, but in a regular person's bank account during the worst inflation spike in decades. Sarah wasn't always financially savvy. Just a year ago, she found herself staring at her bank statements with growing anxiety. Despite dutifully saving for years, she noticed her purchasing power shrinking month after month. Basic necessities were getting more expensive, and her traditional portfolio wasn't keeping up. Like many of us, she'd followed conventional wisdom. Keep some money in savings accounts, invest a bit in stocks, and hold a substantial portion in safe bonds. I realized that the traditional portfolio I had built was actually leaving me exposed during this high inflation period, Sarah told me. It was frustrating seeing prices climb while my money sat there losing value. That's when Sarah decided to take action. She carefully studied the three-step framework we've discussed and implemented it systematically. The transformation of her portfolio wasn't about making dramatic, risky moves. It was about thoughtful reallocation based on inflation-resistant principles. First, Sarah made a bold but calculated move by allocating 80% of her investable assets into quality stocks with strong fundamentals. She understood that during inflation, owning actual pieces of businesses that can grow over time gives her the best chance to maintain and build wealth. These weren't random stock picks. She focused on companies with demonstrated pricing power that could pass increased costs to consumers. Her second step was equally important. Sarah completely eliminated long-term bonds from her portfolio. She recognized that their fixed payments would steadily lose purchasing power as inflation continued. Instead of locking her money into guaranteed losses, she redirected those funds toward assets with growth potential. For her third step, Sarah set aside 10 to 15% of her portfolio for specific inflation hedges. She carefully selected precious metals and energy stocks, which historically perform well during inflationary periods. These assets weren't meant to be her primary growth engines, but rather to act as protective barriers when traditional investments struggled. The real test came over the next 12 months as inflation hovered around 8%. While her friends who stuck with traditional allocations watched their purchasing power steadily decline, Sarah's portfolio told a different story. I was nervous at first, Sarah admitted. Moving away from what I thought were safe investments felt risky. But once I understood how bonds actually perform during high inflation, I realized I was taking a bigger risk by not making changes. The results spoke for themselves. While her friends' bond-heavy portfolios lost significant purchasing power, Sarah's portfolio not only preserved her wealth, but actually gained value in real terms. The specific inflation hedges she chose, primarily gold and energy stocks, saw remarkable price increases that offset losses in other areas during market volatility. Sarah's journey wasn't without challenges. She faced skepticism from friends and even family members who couldn't understand why she was moving away from safe investments like bonds and savings accounts. Market volatility tested her resolve several times, but her education about inflation and investment principles gave her the confidence to stay the course. The hardest part was overcoming the psychological barrier, Sarah explained. We're taught that stocks are risky and bonds are safe, but that's not always true during high inflation. I had to unlearn some financial myths I'd accepted without question. Looking at her 12-month timeline reveals a fascinating pattern. As inflation rates climbed, so did the value of her stock investments, particularly those with strong pricing power. Her energy stock allocation saw steady appreciation, while her gold holdings provided stability during market downturns. Each month, her portfolio's performance validated her decision to implement the three-step approach. What makes Sarah's story so powerful is how ordinary it is. She's not a financial professional or wealthy investor. She's a marketing manager who simply took the time to understand how inflation works and applied proven principles to protect her money. I used to think investing was complicated and only for experts, Sarah shared. But protecting your money from inflation doesn't require special knowledge. It just requires understanding a few fundamental principles and having the courage to apply them. Opportunity in crisis. How inflation can actually build your wealth. Inflation might seem like your financial enemy, but what if I told you that savvy investors actually look forward to inflationary periods? This economic force that most people fear can actually become a powerful catalyst for building wealth, if you know exactly where to position yourself. While Sarah found protection from inflation through her strategic investments, there's an even more powerful approach hiding in plain sight. The truth is, some financially savvy women aren't just defending their money during inflation, they're actively multiplying it. Let's flip the script on inflation. Most people only see rising prices, shrinking budgets, and financial stress. They miss the incredible wealth-building opportunities that appear during these exact same economic conditions. It's like everyone's so focused on the storm that they don't notice the rainbow forming. Quality stocks represent one of the clearest paths to turning inflation into an advantage. When you purchase stocks, you're not just buying pieces of paper. You're acquiring ownership in real businesses with real assets. These businesses generally continue growing regardless of inflation, and smart investors who buy quality stocks at reasonable valuations often see their investments significantly outpace inflation over time. Here's something fascinating about debt during inflation that most financial advisors won't tell you. Inflation actually makes your existing debt less burdensome. Think about it. If you borrow $10,000 today at a fixed interest rate, you'll be paying back that loan with dollars that are worth less in the future. The amount you owe stays the same, but the purchasing power required to pay it off decreases year after year. This is why strategic borrowing for wealth-building assets can actually accelerate your financial progress during inflationary times. Let's look at real estate as a concrete example. Property has historically been an incredible inflation beneficiary. During the 1970s inflation crisis, while savings accounts were losing purchasing power, real estate values soared. A home purchased in 1970 for $25,000 was worth over $75,000 by 1980. A 200% increase during a decade when inflation ravaged most traditional investments. Take Michelle's story as an example. During the 2008 recession, while others were panicking, she recognized that the housing market crash combined with rising inflation created a once-in-a-lifetime opportunity. She purchased 3 rental properties at deeply discounted prices with fixed-rate mortgages. As inflation picked up over the following years, her mortgage payments remained constant while rental income increased annually. By 2022, her properties had tripled in value, and inflation had effectively reduced the real cost of her mortgage debt by nearly 25%. Commodities represent another powerful opportunity during inflation. Assets like precious metals don't just maintain value. They often appreciate significantly when currencies weaken. Gold and silver have served as inflation hedges for centuries precisely because they tend to rise in value as the purchasing power of paper money falls. Let's talk about career negotiations, a wealth-building strategy most people completely overlook during inflation. When companies expect rising costs, they're often more willing to approve larger salary increases. This creates a perfect opportunity to negotiate compensation packages that not only match, but exceed the inflation rate. Lisa, a marketing director, used inflation data to successfully negotiate a 12% raise when inflation was running at 7%, effectively increasing her purchasing power while others were losing ground. The key insight that separates financial winners from losers during inflation is understanding that certain assets naturally thrive in this environment. Businesses with hard assets, strong pricing power, and the ability to pass costs to consumers actually become more valuable. Energy companies, utilities with inflation-adjusted rates, and businesses selling essential goods typically see their profits grow during these periods. Even your career skills can become more valuable during inflation. Specialized expertise that's in high demand allows professionals to command premium compensation. Jennifer, a data scientist, leveraged her specialized skills during 2021's inflationary spike to secure a new position with a 35% salary increase, far outpacing the rising cost of living. Interestingly, inflation can also create opportunities in unexpected places. During the 1970s inflation crisis, women who invested in art, collectibles, and even vintage clothing saw remarkable returns as these alternative assets appreciated rapidly. Claire, who began collecting mid-century furniture in the early 1970s, was able to sell her collection for over 10 times her investment by 1982. The strategy that ties all these opportunities together is positioning yourself as an owner rather than a saver. Savers get punished during inflation, while owners of valuable assets are rewarded. Whether it's stocks, real estate, commodities, or your own specialized skills, ownership is the common factor that turns inflation from enemy to ally. Beyond investing, creating inflation-resistant income streams. Your paycheck may feel steady, but have you checked what it can actually buy lately? While you're working just as hard, maybe even harder, the troubling reality is that your salary's purchasing power is silently shrinking month after month. For most young professionals today, wage growth has fallen significantly behind inflation, creating an average gap of 3% annually. That's essentially a pay cut that compounds over time, even if your salary statements show modest increases. Think about what this means in practical terms. If you received a 4% raise last year, but inflation ran at 7%, you actually lost 3% of your purchasing power. Your higher number on paper masks a very real decrease in what your money can buy. And this pattern isn't temporary. It's becoming a persistent feature of our economy that requires a strategic response. This is where income diversification becomes not just helpful but necessary. Creating multiple income streams acts like a financial insurance policy against the erosion of your primary paycheck. When you rely solely on one source of income that's vulnerable to inflation, you're essentially putting all your financial eggs in a steadily shrinking basket. Let's talk about which side hustles naturally adjust with inflation. Freelance services are particularly powerful because you can regularly update your rates to reflect the current economic environment. Whether it's graphic design, writing, social media management, or consulting in your field of expertise, freelance work allows you to reset your pricing as costs rise around you. Consulting deserves special attention here. If you have specialized knowledge in any field, from marketing to HR to sustainable fashion, you can package this expertise as a consultation service. The beauty of consulting is that clients expect rates to increase over time, and they value expertise enough to pay premium prices during inflationary periods. Digital products represent another inflation-resistant revenue stream with unique advantages. Once created, products like online courses, ebooks, templates, or photography can be sold repeatedly without significant additional investment. More importantly, you can adjust their prices upward as inflation rises without increasing your production costs. This creates a widening profit margin that actually benefits from inflationary pressures. For example, an online photography course you create once can be sold at $97 today, $127 next year, and $147 the following year, all without additional work on your part. Meanwhile, your creation costs remain fixed at whatever time you initially invested. This is precisely why digital entrepreneurs often weather inflation better than traditional wage earners. Passive income strategies offer perhaps the strongest inflation protection. Dividend-paying stocks tend to increase their payouts over time, often keeping pace with or exceeding inflation rates. Real estate investments, whether through direct ownership or REITs, typically see both property values and rental income rise during inflationary periods, creating a natural hedge against rising costs. Consider Madison, a marketing coordinator who launched a template shop selling digital planners and productivity tools. When inflation spiked last year, she simply adjusted her prices by 10% and saw no decrease in sales. Her monthly income automatically adjusted to match the higher cost of living, while her salaried colleagues had to wait for annual reviews that delivered raises below the inflation rate. Then there's Tara, who started a specialized coaching service for women transitioning to tech careers. By packaging her knowledge into both one-on-one sessions and a scalable group program, she created an income stream that could be easily adjusted upward when inflation rose. The key was focusing on providing value that grows more important during economic uncertainty, not less, Tara explained. When people worry about their financial futures, they're often more willing to invest in skills that improve their earning potential. If you're ready to create your own inflation-resistant side hustle, follow this straightforward framework. First, identify a marketable skill or passion you already possess, something people would pay for. Second, research the market demand to ensure there's sufficient interest. Third, set competitive pricing with built-in flexibility to adjust as inflation changes. Finally, leverage online platforms to expand your reach beyond local markets, which allows you to tap into areas with stronger economic conditions. Start small by dedicating just 5 to 10 hours weekly to your side hustle. The goal isn't to replace your primary income immediately, but to establish a supplemental stream that can grow with inflation rather than shrink against it. Many successful expense management began negotiation projects that eventually outpaced their original salaries. Now that we've talked about boosting your income, let's shift gears and talk about protecting what you already have. While building additional streams of income is crucial, there's another side to fighting inflation that many women overlook: standing up to companies that quietly increase your bills month after month. Did you know that 83% of women accept price increases without saying a single word? That silence is costing you thousands of dollars each year that could be protected with just a few strategic words. Think about all the services you pay for monthly: your internet, phone plan, streaming subscriptions, insurance premiums, and even your rent. When was the last time you questioned a price increase? For most women, the answer is never. We tend to view these increases as inevitable, but they're often negotiable. Let me share something that might surprise you. Companies actually build customer retention budgets into their business models. They expect a certain percentage of customers to negotiate, and they're prepared to offer discounts to keep you. When you don't speak up, you're leaving money on the table that was literally set aside for you. Here's a simple but powerful phrase to start with: "I've been a loyal customer and would like to discuss my current rate." These words open the door to negotiation without confrontation. The key is to be polite but persistent. For service providers like cable or internet companies, try this script: "I noticed that similar services are offered at a lower rate. Can you match or beat that price?" This approach leverages competitive pricing information to your advantage. Companies know you have options, and they'd rather keep you at a lower rate than lose you completely. Before making these calls, do a quick market research of competitors' rates. This preparation gives you specific numbers to reference and strengthens your position. Most customer service representatives have the authority to offer discounts on the spot, especially if you mention considering other options. Understanding a few psychological principles can make your negotiations even more effective. The anchoring effect is particularly powerful. By starting the conversation with a lower price point, like a competitor's offer or an introductory rate you've seen, you establish a favorable reference point for the entire negotiation. Let me tell you about Alicia, who saved $840 annually just by making 3 phone calls. When her internet provider raised her monthly bill by $20, instead of accepting it, she called and simply asked if they could maintain her previous rate. The representative immediately offered a $15 monthly discount. She repeated this process with her cell phone carrier and streaming services, saving a total of $70 monthly. Then there's Rebecca, who negotiated her rent increase down from 8% to 3% by having a thoughtful conversation with her landlord. She researched comparable units in her area, highlighted her perfect payment history, and offered to sign a longer lease in exchange for a smaller increase. Her 5-minute conversation saved her over $1,200 for the year. So which expenses should you target first? Start with recurring monthly bills that have recently increased. Services with lots of competition like insurance, cell phone plans, and internet providers often have the most flexibility. Focus especially on services where you've been a long-term customer. Your loyalty gives you leverage. Next, look at subscription services you've had for more than a year. Streaming platforms, software subscriptions, and membership programs often raise rates annually, counting on you not to notice or care enough to cancel. A simple call mentioning your loyalty and asking about available discounts can yield surprising results. Remember that timing matters too. If you're nearing the end of a contract period, companies are often more willing to negotiate to prevent you from shopping around. Plan these conversations for when you have the most leverage. What makes these negotiations successful isn't just what you say, but how you say it. Maintain a friendly, collaborative tone. Your goal isn't to threaten or demand, but to problem solve together. Using phrases like, "I'd really like to stay with your company. Can you help me with this?" positions the representative as your ally rather than your opponent. The beauty of this approach is that it works regardless of economic conditions. While inflation gives you an additional talking point, I understand costs are rising for everyone, but my budget is tight right now. These techniques are effective anytime. The true cost calculator, your inflation reality check. Those negotiation tactics are powerful, but they're fighting an even bigger battle than you might realize. While you're busy saving on monthly bills, there's another financial drain happening right under your nose. One that affects every dollar sitting in your account right now. Most of us focus on the money we actively spend, but what about the money we've saved? That emergency fund or vacation savings might be silently losing value every single day. Here's the shocking part. You can calculate exactly how much of your hard-earned money is disappearing, and it only takes 30 seconds. Let me introduce you to what I call the true cost calculator, a simple formula that reveals your personal inflation reality. Unlike those generic inflation numbers you hear on the news, this calculation shows you precisely what inflation means for your specific savings. The formula is straightforward. Future value equals present value times 1 plus inflation rate, caret number of years. Don't worry if math isn't your thing. I'll walk you through it step by step. Let's say you have $10,000 in savings and want to know what it needs to grow to over the next 5 years just to maintain the same purchasing power. If we assume a 3% average inflation rate, the calculation would be $10,000 times 1 plus 0.03 caret 5. Working through this, first add 1 to your inflation rate. 1 plus 0.03 is equal to 1.03. Then, multiply 1.03 by itself 5 times, or use the power function on your calculator. That gives you about 1.159. Finally, multiply your current savings by this number. $10,000 times 1.159 equals $11,592. What this means is shocking but simple. To have the same buying power in 5 years that $10,000 has today, you'll need $11,592. That's an extra $1,592 you need to generate just to break even. But what if inflation isn't the comfortable 3% in our example? Let's run the numbers with a more realistic 5% inflation rate over 10 years. In this scenario, your $10,000 would need to grow to $16,288 just to maintain its current value. That means inflation would steal over $6,000 of your purchasing power if your money doesn't grow significantly. The results get even more alarming when we reverse the equation to see what today's money will be worth in the future. If inflation averages 3% annually, your $10,000 in 2023 will have the purchasing power of only about $7,400 by 2033. Think about that, nearly 1/3 of your money's value gone. What makes this calculator so powerful is how it personalizes inflation's impact. Those government statistics about nationwide averages don't reflect your reality. If you spend more on healthcare and education than the average person, your personal inflation rate could be substantially higher than what's reported. For instance, if you're paying for college or specialized medical treatments, your personal inflation rate might be closer to 6 to 7% annually, not the 3 to 4% you hear about. Running the true cost calculator with these higher percentages reveals an even more urgent situation. Let me show you how dramatically different time frames affect your money. With a 5% inflation rate, your money loses about 5% of its value in 1 year. But over 10 years, you lose nearly 40% of your purchasing power. And over 20 years, more than 60% of your money's value simply vanishes. This is why understanding compound inflation is just as important as understanding compound interest. Just as compound interest can work in your favor when earning returns, compound inflation works against you with increasing intensity over time. When I first showed this calculation to my friend Emma, she was shocked. She had saved $25,000 for a house down payment, but was keeping it in a regular savings account earning 0.5% interest. After running the true cost calculator, she realized that in just 3 years, her down payment would lose over $3,000 in purchasing power if inflation averaged 4%. This was the wake-up call she needed to reconsider her approach. The most dangerous thing about inflation is its invisibility. You don't get a monthly statement showing how much purchasing power you've lost. There's no alert when inflation has eaten 10% of your savings. The true cost calculator makes the invisible visible by putting a precise dollar amount on what inflation is costing you personally. This isn't about creating panic, it's about creating clarity. When you know exactly what's happening to your money, you can make informed decisions about how to protect it. Your 7-day inflation defense plan. Exactly what to do this week. Clarity without action won't save your savings. Think about it. By this time next week, your money could be actively fighting inflation instead of surrendering to it. The difference between those who watch their wealth erode and those who protect it comes down to 7 simple daily tasks that anyone can complete. Let's talk about turning knowledge into action with a 7-day plan that transforms our 3-step framework into real results. Each day takes less than 30 minutes, but by the end of the week, you'll have completely transformed your financial relationship with inflation. Day 1 starts with assessment. Take a good look at your current financial situation by reviewing your savings, investments, and regular expenses. This gives you the full picture of where inflation is hitting you hardest. Pull up your bank statements and investment accounts, then create a simple spreadsheet showing what you have and where it's currently allocated. This baseline understanding helps you measure your progress as you implement changes throughout the week. On day 2, it's time to identify quality stocks that have pricing power. Remember our discussion about companies that can pass on costs to consumers? Today's task is researching and selecting these inflation-resistant investments. Look for companies with strong foundations, think Facebook and Alphabet, that have the proven ability to maintain their profit margins even when costs rise. Create a list of 5 to 10 of these companies for potential investment. Day 3 focuses on evaluating your bond holdings. This is where many women discover they're most vulnerable to inflation. Take inventory of any long-term bonds in your portfolio, as these are particularly susceptible to losing value when prices rise. Consider whether it makes sense to reallocate those funds to shorter-term bonds or other investments that aren't as impacted by inflation. Your goal today is making a clear decision about your bond strategy moving forward. By day 4, you're ready to explore inflation hedges. Today's task is researching specific options like precious metals, commodities, or REITs that historically perform well during inflationary periods. Decide which hedges align with your comfort level and financial goals, aiming to dedicate about 5 to 15% of your portfolio to these protective assets. Make a list of exactly which inflation hedges you'll add and how much you'll allocate to each. On day 5, set up a tracking system to monitor your progress. This is so important. What gets measured gets managed. Download a financial tracking app like Mint or Personal Capital that can help you visualize how inflation is affecting your money over time. Set up alerts for price increases on your regular bills and create a dashboard that shows your investment performance relative to the current inflation rate. This system will help you stay on top of your inflation defense strategy long-term. Day 6 is about scoring quick wins through negotiation. Remember that companies expect a certain percentage of customers to push back on price increases. Today, identify 3 monthly bills or subscriptions that have recently increased, and make those phone calls using the negotiation approaches we discussed. Even small victories add up. Reducing your internet bill by $15 monthly saves $180 annually. That's money that can be redirected into your inflation-resistant investments. Finally, on day 7, review everything you've learned and done this week. Adjust your strategy based on what you've discovered about your personal financial situation. Make your first investment moves based on the research you've done, even if it's just starting with small amounts. The most important thing is taking that first step. Also, create a schedule for ongoing education about inflation and investment strategies. Perhaps dedicating 30 minutes each weekend to reading up on financial news. I know this process might feel overwhelming. Many women tell me they're afraid of making investment mistakes or simply don't know where to start. Others worry they don't have enough financial knowledge or struggle with procrastination. But here's the thing, you don't need to be perfect. Start small if you need to. Even implementing just one aspect of this plan puts you ahead of most people. If you're feeling stuck, consider reaching out to financial experts who can provide guidance tailored to your situation. And remember, the community section below this video is filled with women who are on the same journey. Share your progress and questions there. The most important measure of your success will be tracking how your net worth changes relative to inflation. Are your investments growing faster than prices are rising? Are you successfully managing your expenses despite inflation? These indicators will tell you if your defense plan is working. The cost of waiting. Why today matters more than tomorrow. While you're tracking your financial progress against inflation, there's a hidden cost most people overlook, the price of procrastination. Every single day you delay implementing your inflation defense strategy, your money silently loses value. It's not just about what you're currently losing, it's about the compounding effect of those losses over time. Let's put some real numbers to this. If you have $10,000 in savings and inflation is running at 3% annually, you're losing about $25 in purchasing power every month. That might not sound alarming for a single month, but think about what happens when you multiply that across a full year, or 5 years. The longer you wait, the more ground you lose in this financial battle. What makes this situation particularly dangerous is how these small monthly losses snowball over time. It's not just the $25 this month. It's the fact that next month, you'll be losing purchasing power on a smaller base amount. This creates a downward spiral that accelerates as time passes. After 5 years of inaction, that initial $10,000 could be worth closer to $8,500 in real purchasing power. A significant chunk of your hard-earned savings simply vanished. The psychology behind delay is fascinating. Many of us believe inflation is temporary or that the market will eventually stabilize on its own. "I'll wait until things settle down" becomes a comfortable excuse that costs far more than we realize. Every month spent waiting for the perfect time to act is another month where inflation quietly chips away at your financial foundation. There's also a significant emotional cost to delaying action. The feeling of watching your financial goals slip further away creates anxiety that compounds just like the financial losses themselves. The dream home, comfortable retirement, or financial security you're working toward becomes increasingly difficult to achieve the longer you wait to implement protection strategies. Another critical factor is that inflation protection actually becomes harder the longer you wait. As prices rise across the board, the cost of acquiring inflation hedging assets typically increases too. The same investment that might protect you today could be significantly more expensive 6 months from now, requiring you to commit more capital for the same level of protection. One investor found this out firsthand when she postponed buying inflation-protected assets. She shared, "The cost of inaction was overwhelming. Every month I waited to implement my defense plan. Inflation continued its silent theft of my hard-earned money. Delaying action for just 1 year meant watching $300 of my purchasing power vanish completely." Beyond the direct financial impact, there's the opportunity cost of what that money could have been doing for you. While your unprotected savings lose value, properly positioned investments could actually be gaining ground against inflation. This widening gap represents one of the largest hidden costs of waiting. The psychological barriers to taking action can be powerful. Many women feel overwhelmed by the complexity of investing or fear making the wrong choice. However, the cost of inaction often far outweighs the risk of making an imperfect decision. Small, informed steps can help overcome these fears and lead to significantly better outcomes than doing nothing at all. What's particularly troubling is how inflation can jeopardize your broader financial aspirations. Whether it's saving for a down payment, building retirement security, or creating generational wealth, inflation doesn't just affect your current savings. It threatens your entire financial future. This makes immediate action not just financially prudent, but essential for protecting your long-term dreams. The good news is that those who take swift action often report not just financial benefits, but emotional ones too. The sense of control and confidence that comes from proactively protecting your wealth creates a positive ripple effect across all financial decisions. Women who implemented protection strategies report feeling more financially empowered and better equipped to navigate uncertain economic conditions. Consider the alternative, continuing to lose purchasing power each month while watching inflation erode your financial security. Every day you wait is another day inflation makes financial decisions for you, and not in your favor. The question isn't whether you can afford to act now, it's whether you can afford not to. As we wrap up today, I want to share one of Warren Buffett's most powerful insights about inflation. He reminds us that the best protection against inflation is to improve your own earning power. As he puts it, if you increase your talents, they can't tax it while you're doing it. This is why your personal development might be your strongest inflation hedge. When you invest in yourself, whether that's through education, new skills, or expanding your knowledge, you're creating value that rises with or even outpaces inflation. The three-step framework we've explored gives you practical tools, but don't forget this fundamental truth. Your greatest asset isn't in your bank account, it's you. Take one step today to invest in yourself, implement what you've learned, and share your journey with our community. Your financial freedom isn't waiting